Hello, it's Richard Geller. I want to talk to you quickly about what you're going to see more and more of, which is questioning how mortgages are being foreclosed and the whole process and how wrong it is. This is my Loan Mod Breakthrough course, and I actually have, we talk a lot about what are called forensic audits, which are going through your papers and seeing when your loan was closed, seeing the violations that were made or may have been made, and then using these violations as a way to club your lender into basically giving you a loan mod that can involve a principal reduction and a new loan entirely that is below the current appraised value. So if your home fell in value in half, you'll actually get a new loan that'll be 90% of the new value and the rest of it's gone. You know, it's written off. This is a real loan mod with principal reduction. So I talk about that, and I also talk about in the course investor-owned loan mods, and I talk about how to fix your credit. And even if you've had bankruptcy, foreclosure, or judgments, I talk about the very complex home affordable plan and how to do mods for Fannie and Freddie loans. Very, very complex stuff, actually. And this is just great stuff. I just want to mention briefly today, there's an article about MERS in the New York Times. And what happened here is that a judge actually threw out a mortgage and said that the mortgage whole foreclosure and the mortgage itself wasn't right, and he threw it out entirely. And this is a rare event, but it has happened, and we're going to see more and more of this. What this involves is, you're going to hear a lot about, is this this MERS. What MERS is a let's see, I think I have it here somewhere. MERS is basically a place for lenders to register who owns your mortgage. So if they sell your mortgage to someone else, they record it with MERS, so it's a central place where they can see who owns the mortgage. But what's happened in recent years is they're not bothering to record mortgages and assignments in the courthouses and recorder offices in the county. They're just recording it with MERS. Then when they want to file a lawsuit for foreclosure, which they have to do in states like Florida that have judicial foreclosure, they're doing it in the name of MERS. And this is what made the judge throw this mortgage out in this New York Times article. This was a mortgage company, this vice president, and all of a sudden she's also a vice president of MERS. You know, basically the banks just fix everything up so they could just, claim that they can foreclose legally, and they can't, because they're not recording the changes in property ownership in the land records. They're not using the assignments. They're not using the statutory provisions that are in the law for recording debts and mortgages that protect homeowners, to protect borrowers, protect lenders also. So I talk about a lot of this and how you can use this to your advantage in my loan mod course, but I want you to be aware of this. I want you to start reading these articles. I don't rely on a lot of this stuff with my course. I rely on laws that have been on the books for a long time. For example, that lenders didn't make sure that you could pay a loan back when they made you the loan, or that they violated the Real Estate Settlements Act when they settled your loan. All things that have been on the books for a while, and they give you a lot of protections, you or your clients. So keep all this stuff in mind, and I recommend you go out and take a look at the New York Times article and start following what's going on with MERS. You're going to hear a lot more about it. Richard Geller, talk to you soon. Thanks.